Mauricio. We need Mao, porque Mao has to do the SI challenge.
Ah, Mao está afuera.
Sí. Nacho. Mauricio. El SI challenge. Está perdido. Se desubicó. ¿Listo? Hola.
Okay, welcome everybody. Welcome back. Testing. I thought I lost some bodies here now, but thank God that it looks like everybody's back. Just briefly, before we move on to the credit session, Mauricio Bernal is going to share with you about a sustainable challenge, so pay attention.
Hello. Okay, hope you guys enjoy your break. Very quick, 2 points to make. You probably noticed some shirts we have at the entrance. This is related to our biodiversity challenge. And this is something that Robeco is doing worldwide, and we're using the app Strava, which some of you probably already know, to track your activity, your exercise. And what we're doing is, if you join, we will hand one of our shirts, official shirts for the challenge. Every minute we exercise, whether it's you walk, run, bike, whatever it is, it will turn into euros that will be donated to the IUCN, which is the International Union for Conservation of Nature. They're located in Switzerland, and the idea is that they help protect biodiversity worldwide. So it's a good initiative we want to have as a firm. If you guys could join us, it would be even better. So that's number one. Number two, in your booklets and the last page, I believe, or so, there is a barcode, it's a QR code. And this QR code will take you to our latest research piece, our 5-year expected return piece, which is the Age of Confusion. It hasn't been published yet. It will be published first week of October, but you guys have the prime piece, a sneak peek for all of you to download. If you use your phone, it will immediately take you to that. So that was it. I will now pass it on to you guys to continue on with the agenda.
Thank you. So we're going to get going with credit. Where's my speaker? Erik. Erik Keller is our client portfolio manager with our credit team based in Rotterdam. So thank you, Erik, for coming all the way from there. I guess similar to how we started, a lot going on in the markets, but also specifically in fixed income. I think there was actually something that we put out recently that is called Building Back Your Fixed Income Allocation. So we're certainly curious to hear what you think about fixed income is specific to credit. I mean, yields have moved tremendously this year, and it appears as if there's a clear opportunity to generate income over the coming years. So with that, by all means, let us know if bonds are back or what's going on.
Let's hope so.
Thank you. Go ahead.
Yeah, thank you, indeed. It's been a challenging time for fixed income investors, and perhaps to do a brief, you could say, back in history context, here if you look at the performance of the treasury market, and we can go back all the way to 1788, that we can see that, and if you take this as a proxy for global fixed income markets, it has really been one of the worst years over a long time. So in that sense, we are in uncharted territory, and perhaps justified. Investors might think, why should I still invest in fixed income when I've had drawdowns so significant this year? I think it does depend on where you are invested in. So let's say if you're more in shorter dated, higher yielding credits, then probably your drawdown has not been as great. But if you have more longer dated traditional fixed income investments or sovereigns, then definitely this is something that we've seen this year, and we've seen a high correlation between the different asset classes. But perhaps to take a bit of a contrarian view, we actually think that at these yield levels and what we've experienced, it can be interesting again to start looking at fixed income. And let me see if that works. Because I think we've seen, of course, a lot of abundance, low interest rates, and that has to some extent also laid the groundwork for the current inflation situation that we're in. But we think if we go back to the basics and why do we hold bond investments, it's really about yield and diversification. And we think that if you look at yields currently, and let's just take yields on a high yield strategy or an investment grade strategy, you are at more than 8% dollar yield. Well, we come from a very low level. So in that sense, the yield levels are much more attractive than they were at the start of the year. And also if indeed the view is that we are entering into a recession, well, bonds don't like inflation. So one of the reasons that we did see that fixed income markets were selling off was with inflation concerns and central banks hiking rates. But historically, we've seen actually that fixed income investments and bonds can perform well, or do perform well in an environment where you have a significant economic slowdown. Now, it's important there that we don't, it's not valid for all fixed income investments, but certainly for higher quality investments, for high yield strategy that focus more on quality. We have seen historically that in years where we see recession, where equity markets correct, that fixed income investments can do well. And that might sound a bit strange now. We've had this drawdown year to date. But if you look at over a long period of time, that's certainly the case. So when we look at the outlook as a credit team, and actually we have become a bit more constructive, and we have been reducing our underweight risk in credit portfolios to a modest overweight for the more higher quality portfolios, so investment grades, but also crossover where we can invest in, let's say, BB rated paper. And we have also reduced the underweight risk in our dedicated high yield portfolios, although there we are still, you could say, at more neutral levels. So we're not there yet, but also there we do start to see that more interesting value opportunities are starting to arise. So typically as a credit team, we look at three components. We look at fundamentals. So what do we think about the economy? What do we think about inflation? What do we think about corporate fundamentals? We look at valuations in the different segments of the credit market. And as said there, we do see more opportunities now. And we look at technicals. So what are investors doing? What's the positioning? What do we see in terms of flows? And what is central bank behavior? And obviously that is an important driver of the current performance of fixed income markets. So when we zoom in on, and I don't want to sort of repeat what has already been said in terms of the top-down outlook, but I do want to show a few charts, and I think this is an interesting one, where typically we've seen historically that in a period where the Fed is hiking rates and hikes rates substantially, that is leading to a recession. So when you look at the yields on the Fed, the chart, you look at the gray areas, this is typically where you see that historically spikes in the Fed rate have resulted in recessions. So when you just look at the central bank policy, and of course dependent on how much the Fed further needs to hike, normally that is not really good news for the economy. And that's also what we're starting to see. We do expect a slowdown and potentially recession for the US economy, but I think also if you look at the European economy. The thing for us to watch as a credit team is inflation, and already we had some views on inflation from the previous speakers, but what is important for us as a credit team is really to look at sticky inflation. And that's the left chart. So if we, outside of energy and commodity prices, look at rental inflation, if you look at services inflation, what do we see happening there? And that's actually the purple line. And there we do see, and that's actually more concerning, that sticky inflation is on the rise and is at high levels. So it's not just about high energy prices, about how high food prices, but it's actually filtering through in different parts of the economy. And another thing to watch is what is happening on the labor market in the US. And that's the right chart. What we've seen is that we were already starting to see last year stronger wage growth in the lower income groups. And that's actually the blue line. But now we are starting to see it more spreading out. So we do see that also the wage inflation is becoming more broadly. And this is exactly, of course, the concern for the Fed. And if you look at the latest inflation print, the Fed does need to continue hiking rates. In the views, we saw a lot of rate hikes being priced in. But now with the latest data, it's clear that they need to continue to make big steps to tackle inflation. When you look at the European situation, also there we have high inflation, but it's actually more about headline inflation. So really driven by higher energy prices, higher food prices, but less if you look at core inflation, it's actually lower compared to the US, and we do not yet see that upward pressure. However, at the same time, we do see that the European Central Bank has now also started to hike rates by 75 basis points. So also there we do see that central bank environment is becoming more restrictive for the markets. When we look specifically at the European situation, this is of course where we really focused on what is happening in terms of the energy supplies. And on the left side, we can see the gas price. We've seen obviously the big uptick in gas prices with the recent announcements that also Nord Stream 1 would be closed. The energy dependence and the impact of higher energy prices feeding into higher electricity prices is something that is a big concern in Europe, and also why we see that the European Union is taking steps here to address this. So to provide support to utilities, to think about ways to cap the energy prices in Europe, but also to diversify away from gas from Russia, but from more liquid natural gas from Qatar, from the US. And I think there Europe is pretty hard investing in trying to make that work. And yeah, we would say this has been, of course, a big driver for inflation in Europe. But also here we do see that we are sort of, at high levels. And the recent news has not really led to further uptick in gas prices. So we are at very high levels. It's not coming down. But as a, let's say, a source for future inflation, most likely it will be less of a driver than we have seen. When we look at the US situation, there, as said, we've seen historically that if the Fed is hiking rates, that will feed through different parts of the economy. And of course, the housing market is one, really important in the US, and also feeding into consumer spending. And there we obviously see that with the increase in mortgage rates, that's the right chart, that let's say the impact on the housing market is clearly there. So we do see new home sales declining. We do see, look at other housing indicators, we see clearly weakness. And also when you look at the equity of home builders, we clearly see that that has lagged year to date. And so the affordability is really a thing, where we see that the higher interest rate environment is starting to have a negative impact on the US economy. So again, if you look at these kind of numbers, it is clear that the slowdown will be there and potentially that the recession will materialize. For us as credit investors, it's, I think, also important to look at, what about defaults, what about the credit fundamentals. And there actually, we see that the fundamentals for a lot of companies is still healthy. Yeah? So if you look at US corporate margins, but also if you look more broadly at liquidity and leverage at companies, a lot of companies have come out of the, let's say, 2021 scenario with, strong liquidity. They've been issuing a lot of debt to make sure that they have enough liquidity on the balance sheet. So we do think that the starting point for a lot of companies is pretty healthy, certainly if you look more at the higher quality companies. So, and we do see that, obviously a lot of companies have to face the higher input inflation. So far, pricing powers of a lot of companies is still pretty resilient. So we do see that a lot of companies are still able to pass through the higher inflation. But it's clear that if inflation and the input inflation will stay at these levels, at some point you will see more companies having more issues doing this. So it's important also bottom up to really identify what our companies are mostly impacted and what companies are still able to pass through some of this higher input inflation. In terms of defaults, defaults have been really low last year and also this year. On the left side, it's the European default rate. On the right side, the US default rate. And certainly if you look at it in historical context, we are at very low levels. So we are below 1%. Now this year, we are slowly starting to see more defaults happening. Also, if you look at our own high yield portfolios and we look at the index, we do see some names in the index defaulting, pharmaceutical companies, telecom companies, but we're definitely nowhere yet near historical levels. But we do think that, with a recessionary scenario, you will see the amount of defaults increasing. And that's why we think, in terms of the fixed income outlook, we would prefer to be more up in quality than really be very much exposed to lower quality high yield, so triple C, or have a large allocation to single B. So in our dedicated high yield strategy, we prefer to have this quality bias, really be underweight those parts of the market, because they will be more impacted by rising defaults, by the higher interest rate environment. They need to refinance at higher rates, but also because we think that valuations for lower quality credit are not as compelling as the repricing that we've seen in more higher quality credit. So there actually we see much more value than lower quality credit. But definitely the default rates will go up. And if you look what is currently priced in, so roughly 9% default rate for Euro high yield and 7% for US high yield. Well, you really have to go back to the 08-09 crisis to get to higher levels. So that is quite some defaults already being priced in. Although we do think for the US market, a bit more repricing might be needed. In terms of valuation, so I would say that on the fundamental side, clearly signals are more inflation and weakness. But I think where you could say, fixed income investments do not like high inflation. I think if we are getting into a scenario where inflation will roll over and where markets are more concerned about the, let's say, slowdown in the economies, and then actually that could bode well for bonds. As said, we've typically seen that bonds perform well in recessions. In July already we saw a bit of more positive momentum, but perhaps that was too soon. But I think here it's important to see at what point do we see that inflation more stabilizing and also the interest rate volatility stabilizing as well. This is a bit of a complicated chart, but as a credit team, we like to look at the different parts of the credit market. And what we show here, and that's actually the first row, are the spread levels, so the additional corporate compensation you are getting on a corporate bond over a similar maturity government bond. And we can compare those levels, and here on the left side we look at European investment grade, so higher quality European corporates. We look at bank debt, we look at bank CoCos, US investment grade corporates, US high yield, European high yield, and emerging market corporates. And then if you look at the current spread levels over government bonds for the different segments in the global credit market, you can compare them to the median OAS. So these are the more longer term average spread levels. And what we're seeing, we've seen a lot of repricing happening in Europe. So of course we are more closer to the crisis. Investors were more concerned about the impact of higher energy prices. Specifically on the banking side, we did see some concern about potential exposure to Russia. So a lot of the repricing we've seen has been on European credits. And that's also what we can see if you look, for example, at year-to-date change. And you can see that, for example, European senior bank debt spreads have widened by 146% compared to, for example, if you would look at US investment grade corporates, only 57%. So a lot of the repricing has happened in the European credit market. And then when you compare the current spread levels with the longer term spread levels, and you can divide it, you get a ratio, current divided by median. Then when the ratio is above 1, it means basically that you're in cheaper territories than we historically have seen. And in the case of European bank debt, but also if you look, for example, at the European corporates in general, we see that the ratio is 2 or 1.7. So you're clearly in what we would consider the top quartile in terms of valuations. You really have to go back 10 years to see these kind of spread levels on European corporate debt. For the US, that's not yet the case. So there we see that the ratios are more around 1. So we do see pricing happening this year. But year to date, the US market has outperformed the European market. And as a result, we see that valuations are not as compelling compared to the European market currently. And then when we look at, but if you would look, for example, at high yield, then we can see that European high yield has a ratio of 1.46 compared to US high yield 107. So in a high yield context, we see more value currently in European high yield compared to US high yield. When we look at emerging market corporates, there you could say we have not, actually emerging market corporates has performed relatively well. So we were mostly invested in emerging market corporates in South America, Brazilian companies, companies in Chile, Mexico, and they've actually held up relatively well compared to the European credit markets. So in our portfolios where we have a bit more flexibility and we can also allocate to emerging markets, we've actually rotated away from some of the emerging markets into European credits. What is also interesting to see, what have we seen historically in terms of spread widening? Because we have seen already quite a repricing in corporate bond markets. And if you look at current levels, and on the left side we see the spread levels for the US investment grade market. And there you can actually see that we are approaching cheap levels. Also, if you look historically, we look at the number of times that we've seen spread levels, being really above 200. Not so much. So we have seen in COVID spread levels much higher. But if you're currently at a level of 200, that is relatively cheap. On the high yield side, it's a bit different. There we see actually that the tail for high yield bonds is a bit higher. So when markets are really getting concerned about recession, you could see more spread widening on the high yield markets. So there we would say we are not there yet. And that is also a reason why we don't want to be overweight high yield yet, but also where we don't want to be underweight, especially if you're more focused on the higher quality high yield. And we think that a lot of that, let's say higher spread levels will come from a repricing in lower quality bonds, so single B, triple C bonds. What we also start to see is more dispersion. So as markets are getting more concerned about the impact of inflation and the growth slowdown on companies, we do see difference in performance between sectors and companies. And this is, of course, where we, as an active manager, want to try to identify the ones that we want to be invested in. But I think very importantly for high yield and fixed income portfolios is trying to avoid potentially distressed names. And I think this is another way to look at European then really look at high yield bonds and then comparing European high yield versus US high yield. And so if you look at the chart, basically what we see here is that the premium, the extra spread for European high yield bonds over US high yield bonds is now more than 200 basis points. And again, you really have to go back to 2018 to find similar levels. So yeah, we do think that from that perspective, it makes sense to look at these oversold markets and identify opportunities. In all fairness, we do see opportunities in corporate high yield, but where we also see opportunities, for example, is in financials. We see that a lot of bank debt has been trading at wide spread levels, as we have seen, and you're basically able to buy subordinated bank debt at spread levels that are much more compelling than corporate high yield. And what we think is that, yeah, if you look at the current crisis in Europe or recession, this is not a banking crisis. So we don't think banks will be at the heart of the current crisis. For example, if you would look at the banking sector, we see that capital ratios are quite strong, whereas at the same time, valuations are quite compelling. So where we have the flexibility and we want to allocate more to bank debt, because we think in an environment of slowing growth and high inflation, higher rates, being invested in bank debt makes a lot of sense. Within our dedicated high yield strategy, we do have some flexibility, but no more than, let's say, 5 to 6%. So it is a nice way to have diversification in a corporate high yield portfolio, but in other portfolios, we will be able to, to have a stronger allocation to bank debt. And we talk a lot about spreads, so how attractive are spreads over government bonds. But I think what is also important to highlight is the yield component. And so here we've seen, if you look at the all-in yield for higher quality credits in the US, yeah, we are approaching at levels we've not seen in the last 10 years. And I think that's really important to highlight. Ultimately, the yield is the most important driver of returns on fixed income portfolios. So yeah, yields getting at more attractive levels would also mean that the future stream of return on a fixed income portfolio will also be more attractive. And it also means that your yield cushion for future volatility, for future rate rises has also increased. I mean, if yields are at 0.5% and then rise to 1.5, there will be a much larger negative impact on your price of a fixed income instrument. Whereas if you're already at 5, or in this case, 5% level, then you can absorb much more further yield rises before you end up in negative territory. So we do think at these levels it makes sense, and especially if you think about a potential scenario where you will see a slowdown in economic growth, then yeah, you might expect that will actually work in favor. If you look at the high yield, the same chart for high yield, there I would say we're not there yet. So yeah, we've obviously seen a big spike around the COVID times when we saw spreads widening significantly on high yield bonds. But we're approaching levels that we saw in 2015-16, when also high yield markets sold off as a result of the energy weakness and the weakness in emerging markets. And actually there was a period when we increased a lot of risk in our yield portfolios because we saw a lot of value opportunities in energy names, for example. And so we are approaching these levels. So once we see that widening a bit further, there could be a reason to add more risk in the portfolio. Let me just move on to technicals. I think one important thing to highlight here is we spoke about the central banks. A bit difference between, if you look at what the Fed currently is doing, let me just go back to the previous one. The difference, also the ECB is hiking rates in Europe, and the Fed is, of course, a bit more further in the cycle in doing this. But I think an important difference between the Fed and the European Central Bank is that the Fed will also reduce their balance sheet, so they will be running down their balance sheet. They've been buying a lot of sovereign and mortgage debt, whereas the European Central Bank will keep on, basically they will not be buying more debt, but they will not reduce their balance sheet. So they will keep reinvesting their current holdings in European corporate bonds. So on the margin, that is somewhat more accommodative than we see for the Federal Reserve, where you have basically hiking rates and also a rundown of the balance sheet. So that is more restrictive in terms of the impact on markets. We've seen, of course, negative flows year to date. At some point, this will stabilize. I think we definitely, at some point, we'll see this as a more positive technical. I mean, a lot of investors, and we do hear that also from speaking to clients, are very much underweight fixed income. So the next step could be that at least start reducing the underweight. And that could become at some point a more positive technical. And on the issuance side, we see that especially for our yield markets, we've seen not a lot of issuance this year. So that's a bit different from the higher quality markets. On the investment grade side, we have seen a lot of issuance, but also at lower levels compared to last year. And obviously, if markets are weak, then companies are a bit more cautious in issuing new debt. So we don't think we will probably see some uptick in issuance, but certainly not to the levels that we've seen in the last couple of years. And in the more recent weeks, we've actually seen more banks issuing new debt. So banks have been a bit more active in coming to the market, issuing debt. And what is interesting for us is that we prefer to buy into the primary market, where we do see that companies are issuing bonds with at more attractive spread levels than in the secondary market. So this is also a way to participate in new issuance to generate some additional return for the portfolios. So yeah, if we sort of summarize it in terms of the overall positioning, so when we look at the chart, we always like to look at the credit cycle. Well, clearly we're now in bear market territory. We do see that investment grade is a bit further ahead, so there we see more repricing. So we're a bit more constructive on investment grade, higher quality credits, but also on BB rated credits, so higher quality, high yield. Whereas for lower quality, high yield and emerging market credits, we would need to see further repricing. So we do think their spreads can move a little bit wider. And that's why, in the portfolios, in our, let's say, dedicated investment-grade fixed income portfolios, we've already gone to an overweight risk. But for the high-yield portfolios, we've gone from an underweight to neutral. And there the focus is really on the BB space, and we're underweight the lower quality parts of the market that are more sensitive to a rise in defaults. And then, as said, where we can, we do like to be invested in financials, as we think they are, well capitalized and should be outperforming the more corporate space. Then perhaps to one slide to make the case on, why would you invest in high yield? Because I think what we've seen is, and I think that's again an important feature of fixed income markets, is that historically we've actually seen, that's the left chart, that we do not see a lot of subsequent years of negative returns on high yield markets. So this year is obviously a negative year, and we've seen that also in 2008. But yeah, historically, we see most years are positive for high yield. And the reason for that is that the income generation part is very important in the total return. And of course, if the income is very low, then it will be mostly about capital gains. Can prices rise for high yield bonds to make my returns? But if you look at the right chart and we can look at the breakdown of total returns, then we can see that, and that's the blue bar basically. So historically, we've seen that the total return on high yield on average has been 6.6%, and that has come mostly out of the income return. So the income return is 7.8%. So your income part, your carry, your yield is your most important driver for fixed income returns. And of course, I think that's the good news now. We are at much higher levels than we were at the start of the year. So this income feature, again, will be an important driver of fixed income returns going forward. And so we see that, and that also means that, at higher yield levels, high yield investments will be less sensitive to the over volatility in prices. The caveat here is that we do want to focus on quality. So we don't think this is the same case for if you would be investing in CCC credits. But definitely if you invest in let's say, higher quality, high yields, we do think this is a very strong feature of the asset class. And also where we think that the diversification benefits of investing in general in fixed income, but also in high quality, high yield, is starting to make sense at this point in the cycle. And I know it sounds a bit contrarian. We've seen a lot of drawdowns, but we do think that's an interesting feature. And my last slide would be, if you look at the drawdowns for high yield markets, obviously disappointing year to date. But if you look at the left chart and you compare the performance of high yield, and specifically our high yield strategy in purple, compared to the equity markets, then you could still say, even in the worst equity episodes, the volatility, the drawdowns on high yield investments are still significantly lower. And also, I think also importantly is that we see in the worst performing government bond markets, so where you really see yields rising, that high yield strategies can outperform. So I think it's important to highlight this diversification effect. And I think what is important here for high yield especially is that high yield typically has a lower duration compared to more traditional fixed income strategies. So if you would be investing in government bonds or higher quality credit, you do get a higher interest rate sensitivity, typically duration 7-8 years. Whereas if you would look at dedicated high yield allocation, you have a duration of 4 years. So you have a higher yield, a lower duration, lower interest rate sensitivity. And as long as you stick to an upper quality bias, we think it makes sense to at least take a first steps in a high yield investment. So let me stop here. See if anybody disagrees.
Jerry.
Hi.
Big supporter of your fund, got lots of it. Thank you.
You're welcome.
The question is a little bit, I want to know what your thoughts are on the adequacy capital ratios of European banks. So So we have several things. The first one, the majority of the mortgages in Europe are adjustable, as opposed to the US, who take long-term fixed rates. So down the road, consumer is going to be affected in Europe. How do you see eventually defaults happening there? Secondly, we haven't had anything explode so far, but there are derivatives desks in European banks. Somebody took the wrong bet on energy or something, something can happen. So can you talk a little bit about the capital ratios and how you feel comfortable about that? Thank you.
Absolutely. And so I think one of the reasons that we like European banks is that we have seen that capital ratios are quite high level. So on the regulation, we've seen that capital ratios have really increased for a lot of banks. Of course, this is I don't want to generalize that, there will always be differences. We also see that the loan provisions that European banks have been taking around COVID have really increased. So, and they've not used those provisions at full. So if you indeed see some companies in the SME sector not being able to pay back their loans, potentially defaulting, then they have quite some provisions to absorb this. On the other, and also what we see is that, and this is not relevant for all European banks, but especially Spanish banks, some Italian banks, some German banks, they are also more interest rate sensitive. So that means that what we've been seeing is that they are actually benefiting from the higher interest rate margins. This is not for all banks the case, but we do see, if you look at recent earnings for a lot of European banks, that earnings actually have been quite solid. Now, we're debt investors, so for us it's more relevant to see, will there be a hit on capital ratios? And there, we've done a lot of stress testing of European banks, and we don't think there will be a big impact. We've even had a bank like, and that actually relates more to Russian exposure, with a Raiffeisenbank in Austria. They were one of the few banks in Europe that were more exposed to Russia. They have quite a sizable operation in Russia. And there we said, well, if you have really a walk-away scenario, so if they really have to walk away from the Russian operations, what will be the impact on the capital ratio? And at that time, in a worst-case scenario, it was a 1% capital hit, and that would mean that they would still have sufficient buffer to pay out their lower Tier 2 debt, their AT1 CoCo. So we did not see that as an issue. I think it's more about the indirect mechanism, right? If you have a recession in Europe, then indeed you will probably see that earnings will come down for some of the European banks, and that the loan losses will increase. But as long as they are well capitalized and they have loan provisions, they should be able to absorb it. And the other thing is that European governments have been pretty supportive in terms of the SME sector. So there are a lot of implicit guarantees to companies that actually, you could say that a lot of the risk has been taken over by European governments as opposed to bank. And that's actually something we see now again with the energy crisis. So the European governments are really willing to step in to provide support and guarantees to the utility sector, to the financial sector, to make sure that the energy crisis does not become, let's say, systematic risk. And so I think it's important, so I think in general we see that the capitalization is solid, but we of course always stress test the banks that we would invest in. But if you have a solid bank and we're willing to buy the subordinated debt, it's a way to get the additional spread. Yeah, you're welcome.
Thank you, Jerry. More questions? No, I think that's
okay. Thank you.
Thank you, Erik. Thank you, Erik. So hello again. We're moving to our next session. Nicolas Beneton, please join us to the stage. Nicolas is a client portfolio manager for our Robeco SAM range of funds. He will be discussing a little about on sustainability. Maybe this is new to Morgan Stanley because you don't have a lot of funds approved yet, but please stay tuned because we're working with headquarters, so you're going to hear more about this. During this presentation, we want you to learn more about our sustainable capabilities, what sustainability means to us. Maybe you don't know, but we have been doing this for more than 25 years in Robeco. This is basically in our DNA. So today I would like to ask Nicolas, what is sustainability to us? How to approach sustainability, how we add this into our investment process, and give us some investment opportunities, mention some of our flagship funds that hopefully are going to be on your platform really soon. So with that.
Do you have a pointer or something? I saw Mike was playing with a pointer. That's a pointer,
yeah,
okay.
That's it.
That's the reason why I do this job, is be able to. I hope you hear me well. So I'd be glad to answer all these questions for Jetta, but you would need to lock down everyone here for 2 days to address all this. So let's remain reasonable and limit ourselves to the sustainable thematic approach that we have at Robeco. Most of my colleagues are based in Zurich, Switzerland. There are 15 investment professionals working closely with our trends team based in Rotterdam, which is well known here, and Ed Verstappen was a great member of the team. So let's get started. Oh, that's the pointer. Okay. I'm going to tell you a bit about my holidays in France first to set the scene. Well, maybe I have to come out now. It's not my holidays, because every time my children hear that I'm talking about them in conferences or anything, they end up saying, you are using us in your work, you have to pay us. So it's fake pictures, but let's assume that's my family that you would see here. So we would have started on the west coast of France. I hope some of you have not limited their visit of France to Paris. Atlantic coast, very nice, but not that much water, actually, a bit disappointing. Then we would have headed to Bordeaux. It was a bit hot. Not such great time that we had here, and this made us think that, an advice to you, if in a few years from now you are proposed a bottle of Bordeaux wine from 2022, just watch out. It might have a bit of a smoky flavor. Heading to Nice, French Riviera, continuing the Tour de France. It was a bit difficult to find any space there, not what it used to be. So back to Paris, then, where I live. I live actually not so far from here. Again, not the best time to bike here. Not such great holidays, which made me really almost happy to go back to work, to my usual megatrends. These megatrends that we have identified in Zurich, that's what you can see here. So we cannot reinvent the wheel every day. I'm not sure any of you will find these megatrends really surprising or coming out of nowhere. Climate change, resource scarcity, demographics. But they are very important because they are integral and structural to what we do. And what we do, the fund range that we run, so all 6 strategies, soon 7. We're going to add a biodiversity strategy to the 6 challenges that you see here. So all of our strategies, our sustainable thematic strategies, they mean to address one way or another challenges relating to these megatrends that made my holidays in France a disaster. Now let's look at how we structure these thematic funds. So it's nothing new to us. It's nothing new to Robeco. The Zurich Robeco Switzerland activity was created back in 1995. It was then called SAM. SAM standing for Sustainable Asset Management. So I guess you see where we're coming from. And sustainability is always the starting point to anything we do from Zurich. So these megatrends are always, one or several of them, are always a starting point of what we do. But it's very important to not to stop here, because just identifying megatrends, it's good for ETF providers maybe, not for active fundamental managers. If you would just stop here, I bet you would not go very far. Just identifying megatrends, you could end up with the top 10 of the S&P 500. Any company, one way or another, addresses one of these megatrends. What you absolutely need to integrate is one of these ingredients on the left. I will not elaborate too much on technology. I believe that's a given. There was a very interesting conversation between growth and value, and here I have to say I would clearly take Ed Verstappen's side. We have a lot in common, of course, and probably the strongest common point that we have is that we invest in highly innovative companies, growth-oriented, not growth in terms of style. I will elaborate on it a bit later. Growth in the sense that we invest in these forward-looking companies, providing solutions for the future and with high technology added value. but it's also very important to integrate societal awareness when defining a theme. We're not academics. We do not aim to win prizes, although we may like that, but we aim to build resilient and highly performing portfolios. To that end, again, spotting megatrends or technologies is not enough. You need to be mindful and aware of the stage of development of this or that technology. If it's too soon, you might wait 2 to 3 years before being able to monetize it. And well, this is my second time in Miami, but I cannot picture myself coming to you every year, so maybe several times a year, and saying, yeah, no, don't worry, it's going to deliver next year, I promise. Might work once, twice, but then you say, okay, the guy, it's 3 years, he's talking to me about this carbon capture technology. In the end, it's never going to work. But conversely, if we would be addressing, telling you, okay, we find now that renewables is a really great investment, so we are thinking of adding some to our portfolios, you're probably going to think, well, the guy is decades late. There's no money to make. This sector is completely commoditized, which is true. So it's very important to build resilient portfolios to be able to monitor and make a fair assessment of the level of awareness of this or that trend, this, that technology. Last but not least, and don't worry, there is no slide on regulation. Regulation is boring also for us, but even if it's boring, you need to have regulation on your side. And thinking in terms of sustainability objective is the insurance always to have regulation on your side. It's true, and it's turned out to be extremely helpful in many, many investment cases across all strategies. EVs is one, for instance, just to name one, but regulation is a very strong driver of most sustainable themes that we have developed. Then are we value, are we growth? I'm not going to answer that question yet. Well, I can give the first part of the sentence, of the answer, which would be we don't care so much, if at all. Are we large cap or small cap? Do we invest more in that sector, that region? Honestly, it does not matter so much, because what thematic investing is trying to achieve is to see through these traditional asset allocation criteria. And if you had to define thematic investment, you would be more keen to use the type of companies and to address the type of companies that we have in portfolios rather than the standard positioning. What makes us really specific, what differentiates us from the crowd, is really the type of companies we invest in more than where they are headquartered or the sector they belong to. So we invest in sustainable thematic providers. That's a very different type of companies from the main ones in traditional benchmarks, and that's really what making a difference in thematic investing. So what makes sustainable thematic investing specific, and why has it become so popular? So popular with differences across markets and regions, but I think this graph is self-explanatory. You have a certain type of storytelling that's also very much true for some blockbusters that you know well, for fintech, for consumer trend, but also for our smart mobility fund or a circular economy fund. These funds make sense, and because it makes sense, they are fairly straightforward to explain why we do that. We don't need to find very long explanations as to how the idea came in. More circular economy, I think it's stating the obvious. Smart mobility, electrification and development of autonomous driving. So too bad David from Boston Partners left. We would have had a fascinating discussion as to our expectations in the development of the EV market in the US and elsewhere. But clearly, storytelling is important as well as performance. We managed to generate outstanding returns across most of our strategies over the past year, despite the fact that we are not exactly value investors. You will see in a minute that it doesn't matter so much. and also because we managed to bring diversification to different type of investors, from private wealth to institutional investors. This type of companies we invest in, these solution providers, they provide diversification, again, beyond the geographic or sector traditional asset allocation framework. Through stock picking, that's how we bring diversification. And last but not least, the thematic funds generally fare better on ESG, but as I will elaborate in a minute, it's not only better, this is much better. This is much better because we are high level, let's say, sustainability fund, in the sense that sustainability is not a nice to have. This is not just one feature of our investment process. This is the overarching objective of our fund range. So by definition, everything we do is sustainability oriented. And from this traditional sector approach, which is fine, no problem, but which is just investing within a range of activities as defined by benchmarks providers, we invest as per the activities and products, services from companies. So we have added the sustainability development goals here from the United Nations. They are not the only way to define sustainability. At Robeco, that's a framework that we have broadly embraced on credits, on equity processes, including sustainable thematics. We find this very helpful. But this helps designing then sustainability strategies. Yeah, maybe for the sake of time, I will skip this one. It was nicely displayed though. Sorry about that. Yeah, so continuing on the popularity of thematic funds that have really become of interest in most regions of the world, more so in EMEA, to be honest. In Europe, they have become quite a substantial part of equity allocation, but not all thematic funds are even, neither in terms of performance nor in terms of flows. I'm doing sustainable thematics, so what do you think I'm going to say next? Of course, that's the best performing funds, and the funds having attracted the most flows are sustainability related. This is obvious when looking at this. So there's no good or bad thematics in the end. There are just different thematics. And that was, by the way, evidenced by a very good study by Broadridge that I will be using quite extensively, by the way, in this presentation. This was released just last week. So that's the reason why I changed many slides a bit last minute, and which is very enlightening as to the different versions and differences within thematic investing. So the conclusion here is pretty straightforward. There is a difference within thematic investing. Not all theme funds are equal, and sustainability-oriented thematics attracted the more flows. The differentiation in terms of stock profiles that I already alluded to, you can see it here. So I chose the example of our smart material strategy and explain what's the difference between investing in the materials sectors with mining companies, chemicals, specialty chemicals, and the likes. You are all familiar with it, and buying a product based on that, and investing in a thematic materials fund. We think in terms of value chain, and within or across a value chain, you can find several sectors. So let's say you mean to invest in batteries. There are lots of ETFs with this. And by the way, many clients, they try to recreate our funds playing around with ETFs. Why not, if it's just playing around? But it's very difficult to make because it doesn't match any standard classification. If we wish to invest in the battery value chain as a proxy for electrification of transport, we have the choice to invest either in lithium producers. They are not lithium miners, by the way, if you know the process a bit. These are fairly different companies. So we can have direct exposure to the material itself. But in many ways, we can get exposure. This lithium producer will be more exposed to spot prices, another one less so. A third one will be more exposed to South America, another one to Australia. So basically 1,000 ways and many names to invest in, and that's a stock picker job to pick the right ones. But we can also decide, let's say prices are coming down, to change our allocation to the value chain, sticking to our investment thesis, sticking to the lithium value chain. We can decide to invest in battery pack manufacturers, so they will benefit from lower lithium prices, buying inputs at a lower price. Or we can also decide to invest in cathode or cell manufacturers, for instance. Very different, using different proportions of lithium versus manganese versus nickel versus many other things, and still invest in battery manufacturers. What we might decide to do eventually is also invest in auto manufacturers. This is not our preferred solution because we only invest in solution providers. Solution providers are pure plays, so traditional auto manufacturers are not part of our investment universe. We are not interested in these companies transitioning. I mean, it's really good, and hopefully this will be good for us all, but we don't think they will be the winners anyway. Conclusion on this slide is that thematic investing does not equal sector investing, and it's a lot about stock picking. It's a lot about defining the right spot, the sweet spot across the value chain, and picking the winners. My favorite question, growth versus value. Are we growth investors? We hear that a lot. We have heard that a lot. Your great performances, it was only because you were growth investors. If you still have in mind these graphs from Boston Partners earlier, yeah, it's stating the obvious. We had a good time and now it's over because we are beginning a new value cycle. It's all about value. Maybe, we don't know, and we don't care so much. Not only because fundamental investing, it's not about only choosing one side, and I think that was one of the conclusions, right, from Ed and David speaking together. They agreed on many things, so that might also be that, well, one is not that value-oriented, and the other is not only growth-oriented. That's not how we think. We don't think that the world is split between growth and value, and we also don't think that the world is defined by liquidity, momentum, and quality. We aim to capture a premium from investing in solution providers. That's very different. But you don't have to believe me. I understand that's not something you may want to do. At least believe MSCI. We have plotted this data from MSCI Barra. This is not enough even from Robeco factor investing platform. We could have used it, but this would have been internal data, and you might have thought, okay, it's Robeco assessing Robeco. We picked MSCI, objective, broadly used data. 4 different funds, going from smart energy, investing in IT, materials, a bit utilities, many industrial companies, to sustainable healthy living, investing in healthcare, consumer staples, consumer discretionary. Very different profiles. You will find some slight differences. I hope you do see it well. And these dotted lines are the significance levels. So basically, if a bar is above or below these dotted lines, it means that we do have active exposure. These are the active exposures versus MSCI World, not even absolute. So we do have a low size exposure, but from the moment you do not invest in the Amazon, the Microsoft, or Meta of this world, and obviously they are not thematic stocks, you have a low size exposure. Maybe let's leave this one apart. Value, we have a negative exposure to value. Sorry, I got carried away talking about value. Yeah, it's not really a surprise because we would not define ourselves as growth investors, but certainly not as value. Reason is simple, is that valuation can never be the starting point for investing, never. We do take into account valuation. We do not buy anything at any price, but the starting point of an investment case with us is what does the company do, to what extent this contributes to sustainability objective. Very simple. Valuation has nothing to do with this. Valuation will be scrutinized in the second tense. So, yeah, not really a surprise. But then to those of you who might want to classify us and assign us a growth stamp, just look at that, this green bar on the left. This is sometimes positive, sometimes negative, never significant, never. And it's not me saying, it's not our marketing department, this is MSCI. So the fact that all thematic or thematic investing equals growth, I'm sorry, it doesn't work. It might be a compelling statement, but this is not, unless you can find other academic studies. So maybe some pure tech-related thematics will end up having a growth exposure, but what we do doesn't. Also, I'm not going to spend too much time on this, but then if I'm telling you, you should not use sectors, you should not use country, we are style agnostic, you cannot qualify us, you might get out of this room thinking, okay, I don't know what to do with this guy, or with his funds at least. So it's not as simple, and we do strive to provide you with some metrics and risk management indicators, because obviously any fundamental approach needs a very stringent risk framework. That's why we have developed thematic benchmarks that we use on top of MSCI World. MSCI World is our performance index, meaning that we aim to outperform such indices that you are using too, but we are referring in terms of positioning to our internal benchmarks, which reflect our true investment universe. Therefore, you can do the comparison between our benchmarks and the MSCI to judge the value added from the theme itself and the value added from the PM versus this internal benchmark, meaning does Robeco do a good job when picking stocks within the universe. Yeah, maybe skipping on this one on impact. I don't have that much time left, and I cannot skip inflation. Everybody's talked about inflation. So again, where will interest rates be? Will inflation in the US be higher than in Europe? We have no clue. We take this as a given. I cannot say we don't care. Of course we care. But what we care about is the nature of inflation. And what we have seen is that inflation for intermediary goods, meaning goods that are part of a final good, these parts and pieces that are used across an industrial manufacturing process, react differently. So inflation came to us, hit us earlier on, already mid-2021. This started with the semi-shortages due to COVID notably, but not only, also activity in China, and then came up again through higher energy prices. So this came in two different stages, but overall we were hit earlier than many other sectors. We have very limited exposure to end consumer products. That's not what we do. We have this pick and shovel approach to investing, and therefore, as we were hit earlier on, we would think that we will also recover earlier. As the end consumer will continue to see higher prices when buying final goods, we think that, notably due to the pricing power that was also referred to earlier on, we will manage to recover earlier and stronger than more consumer-oriented sectors. Having said that, pricing power is not a magic stick. You can be able to manage your prices, but end volumes also matter. And that's where sustainability, again, is a very strong argument, because we are not addressing any markets. Actually, we are addressing a very limited share of what we call mass market, because we aim only products that pursue a sustainable objective and that have a higher value added to the end consumer. We think, in the end, that's the best protection versus inflation, and that was reflected in our approach to semiconductors. So one might ask why we do have 40 to 50% IT exposure in our smart energy fund. That's because it's not any IT company. We do not have Microsoft. We do not even have NVIDIA or Qualcomm. They are not the companies we think that help transitioning to a more sustainable world. We invest in these high value added components for key industries, electric vehicles, solar panels, and so on. So we think ultimately that's the best protection versus inflation. Now, I also wanted to talk about water a bit. So making the link with semiconductor and jumping from more energy-oriented themes to more the water-oriented themes. Semiconductor production came in focus last year because of these shortages and as Ed said earlier, the impossibility to buy consumer goods due to shortages. So I told Ed last year already that he should not have picked this auto manufacturers, but he would not listen to me. Why is water important also to semiconductor manufacturing? Well, it's not only for ethics or for sustainability reasons. This example stems from TSMC. This purely pertains to economics. The manufacturing of one chip, I think it's that big or something, uses 30 liters of water. It's more than 200 million liters of water used every day by TSMC. So it's the same rationale with Apple and Google installing solar panels. I don't think they woke up one morning saying, yeah, we should do good things. No, this is just an economic rationale. If they have to buy so much energy, it's simply impossible. So they needed free energy, i.e. solar panels. Here it's the same. If they would just use and send water away, this would be a massive waste of money. Not only water or natural resources, money. That's the reason why in our water fund and this pick and shovel approach, we invest in utility companies providing water. We also invest in analytical companies whose TSMC is a client for quality monitoring and so on, but also to treatment companies, so these industrial stocks providing valves, pumps, all the equipment, and also in these companies being able to recycle the water to be reused and allowing TSMC to function in closed loop, right? So you can see that from one investment in TSMC, but do you really need us to invest in TSMC? I think if you want to, you can have the idea for yourself. You have many other ways to benefit from this activity pursuing a sustainable objective. So time for me to conclude and leave the next speaker and his fascinating experience, but oddly enough, even if we had not shared before, I think my conclusion resonates well with what he's about to present to you. I'm not going to read it all, just remind you that sustainable thematic investing is no more, no less than pricing externalities. And I'm going to read only the first sentence. This is, to me, the most important one. There are plenty of products that attempt to leverage the latest technological trends without giving much thought to the importance of the problem being solved. That's really what it's all about. So that will be my conclusion. Thank you.
Maybe we can have some questions at the end, if you don't mind.
I mind, but...
So, I don't know where Sander is. So thank you for staying. This is our last presentation of the day. We want here to bring something interesting that is relevant to all of us in your daily lives. And you think over the past 2 years, we have witnessed a tremendous acceleration in trends such as digitalization, such as social media. So we thought, who better than Sander Dubestein, a high top-rated, acclaimed trend watcher, to share his thoughts and insights about this fast changing world. And I think that most importantly here is that he's talking about hot topics as artificial intelligence, innovation, cryptos, the metaverse, and how we need to adapt, to evolve, and try to keep on with all these new things that are happening in this new reality. So don't be scared. I think that is a great presentation. You're going to have a lot of insights that you can share with your children, with your grandchildren, because this is what is happening now and is the future. So with that, I'm turning over to you, Sander. Thank you.
Well,
here you have some water.
Yes, thank you. Thank you for your kind words. This morning I already gave the presentation. It lasted for half an hour, and now I have 45 minutes. So I've been in my hotel room creating all new slides. So I hope you enjoyed it. Well, my name is in Dutch Duivenstein. It means pigeon castle in English. And it was a castle in the Netherlands for over 800 years ago. It doesn't exist anymore, but it's a nice bridge to the pigeon that has this virtual reality glasses on. It's totally fake, of course. And that's what my story is about. We are living in an era where fake and real, we no longer see the difference anymore. I started writing this book with my two colleagues. We work for Capgemini, the International Research Institute, and we research the impact of new technologies on people, business, and our society. And about 2-3 years ago, we started seeing all new kinds of technologies that popped up that started to play with reality. And one of the things that helped us was, how sad it might be, but it was the corona pandemic. Suddenly, what we had projected for 2030 already happened in 2020. And the strangest thing, I had Microsoft Teams on my laptop for several years, never used it. And during the corona pandemic, I always used Microsoft Teams, and I'm still using it. It's the screenification of the world. And if I'm looking around, some people are still behind their screens in another reality, because that digital reality is more important than our physical reality. So some people are even addicted. Strange kind of things happen when we use these new technologies. And strange kind of things, I want to tell a positive story, but I have to tell something about the bad side effects of these new digital technologies. First of all, when the corona pandemic started, we first heard of the term deepfakes, that you can use AI to copy and paste the voices, the bodies of people.
President Trump is a total and complete dipshit.
Obama never said it, but it was one of the first deepfakes created 2-3 years ago. And this is voice, this is his face. AI created it, but it's even simpler. This is a site called Lyrebird. It asks you to read out 25 sentences. It records your voice, and afterwards you can just type in text, and you hear your own voice back to you.
So obviously what I want to do now is I want to try to use this to fool my mom into thinking it's me.
Hi.
Hey, how's it going?
Good, good. How are you?
I only have a second here. Super busy. Just wanted to quickly check in and make sure we are still good for dinner tonight.
Yeah. 8:15.
Okay, sounds good. Text me when you arrive. Sound good?
Oh, great, Charlie. Thank you.
Well, if your own mother doesn't recognize you anymore, how bad can it be? So these new technologies, bad side effects. One of them is conspiracy theories. And there are funny conspiracy theories. There's a huge documentary on Netflix about the Flat Earth Society, that the Earth isn't round, it isn't the globe, but it's completely flat. Thousands of people believe it. I'm one of the addicts of this conspiracy theory. It's a student who made a joke about the fact that birds don't exist anymore. The United States killed all the birds and they are replaced by drones. And it was a joke, but nowadays about 100,000 people around the world still believe it. So funny, bad things. I think in the United States, last January, on the 6th of January, you had the biggest conspiracy theory ever. Bad things. And one of the things we saw is that we are not living in a post-truth society anymore, but we are living in a post-reality society, where we no longer can distinguish the real thing from the fake thing. And after we finished the book, we saw some other things happening. The war in Ukraine. Some people call it the TikTok war. And watch this movie.
Снимаю, братуха! Блядь, чуть-чуть высоковато, ёбаный в рот.
This happened during the first day of the invasion in Ukraine. Some Russian soldiers made a movie about the landing in the Ukraine. 26 million people saw this movie on TikTok. And after a week, we found out that it was an old movie. It was posted 2 years ago on Instagram. But people find it funny, it's entertainment. And what we see again, when there's no more distinguishment between real and fake, information becomes entertainment. Watch, for example, CNN.
And a little bit of chicken fried.
I was totally surprised. This couldn't happen in the Netherlands. But again, information becomes entertainment. And even Zelensky, the president of the Ukraine, he went on television to talk about the different realities we are experiencing.
Украина в ваших новостях и Украина в реальной жизни – это две совершенно разные страны. И главное, их отличие в том, что наше настоящее.
His reality is real, and the reality of the Russians isn't real. But is he real, or is he a deep fake? Do we know this or not? So it's all about playing with reality, and that's why that's the subtitle of our book. And I've now spoken enough about the bad things. I'm now going to talk about the positive things we can do nowadays with these technologies. The Queen, unfortunately she has died, but a couple of months ago, when she had a jubilee, the bear Beneton visited her. Deepfakes in a positive way. The next day, she was already too old, but they made a hologram of her in the coach. The next day, Zelensky was as a hologram at several conferences. And a couple of months ago, I think 2 months ago or something, on America's Got Talent, we had this real-time deepfake. So Obama, it was created by artificial intelligence. It took computers about a month to compute this movie, and now we can do it in real time. This was about 2 months ago. Yesterday evening, this happened.
Look like an angel. Walk like an angel. Talk like an angel. But I got wise. You're the devil in disguise. Oh, yes, you are. The devil in disguise. Oh, yes, you are. The devil in disguise. Oh, yes, you are. You are the devil in disguise.
And the interesting thing is, if you look at the picture, you see 4 cameras before 4 people. So the camera registers their face movements, and immediately in real time he creates a deepfake. So this might be the future of entertainment, and anybody can do it by using his phone. And why is this so important? In our book we describe that we can learn a lot from Generation Z and Generation Alpha. This is the generation that has been growing up with information technology, with the internet, and that's why they have a different behavior, and that's why they think differently about our future. So born for the internet, they don't distinguish anymore between online and offline. They are on live, and they are used to use all these new technologies. They aren't afraid, and it should make them smarter. But if you look, for example, at these girls at a baseball game, they have paid quite a lot of money to be at the game, but the only thing they are watching is themselves. So is this smart? Sports, 15 years ago, nobody had a smartphone. And if you now look at how we watch the game, watch Tiger Woods, how we follow him, there's always this screen between what's happening and what we are experiencing. We are becoming a spectator of our own experience. So does it make us smarter or dumber?
Look at this and tell me what time it is.
Oh, no. No, I can't. It is 4:37. Is that correct? It's 2. I want to say 40. No, not 45.
Chris, let me ask you this. Where do you go to college?
UC Arlington.
You want to say anything to your teachers back in college?
Not at all, because they're going to be so disappointed that I have not read a clock like this since elementary school. Let me see. Okay.
Oh man, it is 8:10, 8:20, 8:17. No?
AM or PM?
And we are laughing about it, but do young people really need to know how an analog clock works? Normally they just ask Apple Siri what time it is. A new, different interface to communicate with information technology. So this young generation, in my opinion, they are quite smart. And that's why I have a little test for you. Can you please all stand up? On the screen you see 24 icons. 24 icons of famous old internet companies, icons of social media companies, icons of games, icons of memes. If you know less than 6 icons, I want you to sit down. Less than 6. Oh my God. If you know less than 12 icons, please sit down. Okay, half of the room is already gone. If you know less than 18 icons, please sit down. Okay, this is it. So this is kind of pathetic. And this lady over here, she was the last person to sit down, so I think you've won the competition. So, but, no, I'm not going to ask. But the funny thing is, the top 2 rows, those are the oldest internet companies, and the 2 rows below, I think that most people won't know these icons, because that's what's happening nowadays in the life of this new generation. And that's where they are going to spend the rest of their lives. So it's important for us, as a company, as a society, as human beings, as parents, to know what this is all about. Because for the youngest generation, internet culture is the most dominant culture they are experiencing. And why is this important, internet culture? Rise of the Minions, the movie, it was released a couple of months ago, and then the strangest thing happened. Lots and lots of people, more than the expectation of the Hollywood company, were going to the movies, and they didn't understand why it was happening. Why was the movie earning millions, hundreds of millions of dollars? Why was it unexpected? Because of TikTok.
Rise of Gru with the Gentleman.
I count money, I count money, I count money. I'm swerving 100. I do it 'cause I did it. I do it 'cause I did it. I do it 'cause I did it. I do it 'cause I did it.
Internet culture is the most dominant culture worldwide. This is today happening. The queue for the Queen. Online people are saying it's the most British thing ever happening. People are standing in line for 20 hours. All kinds of movies are created online, and people are experiencing it not only offline, but online as well. It's one big experience. So what can we learn from this youngest generation? One of the things is, for them, the most important thing is their online identity. It's more important than their offline identity. They feel more comfortable online than offline. And, well, the fact that they are always online, this is happening today as well. A Belgian reporter uses AI to look at an Instagram picture, uses an open camera to find out the moment that the picture was taken. So about privacy, that might be an issue with these new kind of people, but I wanted to show you it. This girl, she's standing in front of a pink wall. It's the wall of Paul Smith, the shop in Hollywood. Young people are traveling from all over the world to stand in front of this wall, to make a picture because it adds to their online status. It's the biggest sightseeing thing in Hollywood nowadays. And the funny thing is, the neighbor responded a couple of weeks ago, "Fuck you with your selfie." So not everybody likes it. But if you look at young people nowadays, the way they dress, the way they make up, they have these Nike icons turned upside down on their eyebrows. They have the lips blown up. It's the age of the Instagram face.
Just last week, I had a patient come in and ask me for more of an anime eye, and she couldn't figure out why it's not possible.
An anime eye, did you say?
Yes, to have her eyes made like roughly 3 times larger than what she already had or what she currently had. And that's just one of the things. It all comes from a self-absorption. Well, you can call it an obsession sometimes. It first started, with looking at yourself in the mirror and looking at photographs, then digital photography and being able to manipulate things on applications. The selfie generation, we had a different set of adjustments that were being done, and now we have applications that can even make you look like an animal.
So, in the near future, your new colleague might resemble like an animal, but young people, 16 years old, are going to a plastic surgeon to make their face resemble like their selfie, like the filters of Instagram and Snapchat. So they call it Snapchat dysmorphia, and I think that's a bad thing. But again, the real and the fake, what's the difference? This girl, she's called Little Nicolas. She's 19 years old. She has Brazilian and American parents. She has 3.6 million followers on Instagram. She's supported by all big clothing brands, and she makes her own music that you can listen on Spotify. There's one thing, she doesn't exist. She's completely created by artificial intelligence. This is a virtual YouTuber. On the left you see Code Miku, and on the right you see the person who created this character. She wears a suit with all kinds of sensors. She has a phone in front of her face that real-time renders her face movements, and then the end result is Code Miku. On her chest you see text. That's her business model. She earns money because people are buying text on her chest. It's an advertisement model. This is the old version, Code Miku 1.0. This is 2.0. And you can see how realistic it becomes. No more difference between real and fake. Samsung is creating neons, virtual humans. They might be a doctor, an architect, a teacher, anything basically. They might become your next colleague. If you're now still working with chatbots, give them a human face, a human voice, and they can work for you. So your online identity becomes more and more important in the near future, and especially for young people. So real is a new fake, one of the first laws of our book. One of the other things we are talking, it's about the evolution of media, what comes after social media. And social media, it has been big for the last 10 years. It's the way a lot of people are earning money. They use it to sell their products. In the beginning, analog media, the first printing press, books, newspapers. Then electronic media, the radio, the television, the telephone. The last 30 years, digital media, social media, Facebook, Twitter, LinkedIn. And now we see the upcoming of synthetic media, where you can use AI to create new kinds of content. And what synthetic media exactly is, well, the next lady is going to talk about the definition.
Synthetic media is a catch-all term for media. such as images, sound, text, video, and virtual experiences, or a combination of synthesized pieces of information that is either manipulated or wholly generated by artificial intelligence.
I bought this lady. She's not real. She costs $30 a month. She's from Synthesia.io. And you can just pick up an avatar, a girl or a boy. You can pick up the skin color. You type in some text. You push generate, and immediately it gets generated. So no need of a cameraman or a sound engineer. It's just adding some text on a website, and you get this kind of movies produced. This painting last week earned a prize in an art competition. It won the first prize. And then immediately people were frightened because it was created by AI. And now we get these exciting new tools like Midjourney, DALL-E 2, and Stable Diffusion, where you can just fill in some text in a command prompt. For example, this text, and it immediately generates new kinds of images, realistic images. No?
It is because, I mean, first of all, I don't have to have a Zoom now with a client. I can just put an artificial me pretending to be me. Not there, it's somebody else, you know, whatever. I mean, it is scary. I mean, nobody's going to believe anything now.
Well, well, even if you now look at this, if you use Teams, you can make a different background that's not real. They have even this constant face filter that takes away your rimples. So.
What will that do to society? We're going to be not believing in anything. I think nothing.
What is worse, believing anything. That's even worse.
Well, like today, all these theories and people believing whatever.
Yeah, but this is the question about what is real or not, or what is fake. We have had this discussion all the time.
The problem is, well, I mean, regulation will have to come because they can
Yes.
take and put my face and say that I said something which I didn't or whatever.
Yeah. This is a painting, the girl with the earring, and normally you only see her face. AI generates the environment nowadays by just looking at the picture. So again, what is real or what is fake? The funny thing is that this used to be the experience of large Hollywood companies. It cost them hundreds of millions of dollars to create these kind of blockbusters. But nowadays, I can create them by just using my smartphone. So everybody becomes a creator that can create these kind of things. And it all starts with TikTok. Who's on TikTok? 6 people. TikTok is bigger than YouTube nowadays. It's the most educational platform we are now having. This girl, her name is Kat Norton. She's also called Miss Excel. And every day she releases a small movie of 30 seconds that explains a certain functionality of Excel. She has millions of followers, and she now produces courses online. She earns about 100,000 euros a day because she reinvented the whole educational system. So don't be afraid, but start rethinking about how we can redo our businesses by using these kind of technologies. And young people, I wanted to become the next Mark Zuckerberg or the next Bill Gates when I started working in '96. But nowadays, young people, they want to become the next YouTuber or the next TikToker, the next influencer, because that's where the money is. And they use all these media, they use it differently, completely different than we do. I was always using Google to find my information. Nowadays, I use TikTok.
I don't Google anymore, I TikTok. I want to buy a new face mist, a new face product, TikTok. Not sure how to cook something, TikTok. Like, why would I Google something? And I can go on TikTok, watch a 15-second video, gives me the full lowdown on how to make something, if something's good, how to use something. I get like a little visual of it, and it's literally so easy. Please tell me I'm not the only one.
My children, I have 2 daughters, 16 and 18 years old. They are at high school, at university, and they always get these kind of thick books. They don't read anymore. If you show them a movie, It's better for their education because that's the way they used to learn. So something is happening with digital media. Google, the link graph, it related documents to each other. Then we found out, we invented the social graph, where people were related to each other, they were related to me, and they were telling me on my feed which content I should watch or should read. And nowadays, by using Twitter and TikTok, we throw the model of the social graph completely upside down. TikTok knows exactly what I like. When you first start with TikTok, you watch the movies for half an hour, then it knows exactly who you are and what your interests and your passions are. That's why it's so addicted to be on TikTok. But a different business model to earn money. So if you are an influencer, like Kim Kardashian, a celebrity influencer, their time has now ended. It's all about niche cultures nowadays. Small cultures that certain people interest. You have this movie, there are now 3 movies. It's called After, and After another one, and After blah blah. The movies, they are created by an amateur. She started writing online. She created a community around her writings, a fandom. They started buying her books. And now she has a contract where she has earned millions of dollars. Niche cultures, find a fandom, create a community, and start earning money. A different business model. Well, fake is the new real was the first law. It all had to deal with synthetic media, where AI starts creating new kinds of content. The next big thing we are now experiencing is crypto media, where you can own a certain piece of the internet. You can own a meme. You can own digital art. So, again, a second law, fake will become worth more than the real thing. This is a Gucci bag, and somebody in the game Roblox, an avatar, bought this Gucci bag, a digital bag, for $2,600. You can buy the same bag in any kind of offline Gucci store for $1,400. Why does he do it? Because he wants to look nice in Roblox, or she, I don't know if it's he or she, but the status of his avatar is more important than the offline identity. So fake is worth more than the real thing. So it's all about NFTs. And NFTs, non-fungible tokens, young people are already used to it. They buy digital stuff in worlds like Fortnite and Roblox. And now they can buy digital stuff outside of these worlds, outside of the walls of these games. So this is going to be huge, because we basically have copied the physical world into the digital world. And we can financialize basically everything. Art, digital art. The compilation by Beeple, $69 million. Somebody pays $69 million for the ownership of this digital painting. And I have it as well. But it's all about status. Memes like the Neon Cat sold for 10,000 euros. Somebody is now the owner of the first Neon Cat. The meme disaster girl. The girl in the picture, she's now 21 years old. She has sold the rights to this photo as an NFT a couple of months ago for 70,000 euros or dollars. She uses it to pay her university. Virtual fashion. Young people, because their online status, their online avatar is more important than their offline identity, they pay lots and lots of money for virtual fashion. Nike has bought RFTK, a company that creates digital sneakers. And if you buy a digital sneaker, you then have the possibility to immediately buy the offline variant of this digital sneaker. Collectibles, moments in NBA history. You can buy that moment. You can buy that video clip. You can deal with it. Bored apes, CryptoPunks. People buy them for millions of dollars because it adds to their online status. And they join a club, all millionaires, you have access to them, new kinds of deal starts popping up over there.
How do you show them that you have them? Who do I show it? I thought you have it.
Well, this is the normal behavior of a boomer. Well, it's a, if you buy it, you have to. If you buy it, you have the digital certificate of this unique piece. And this digital certificate gives you access to all kinds of communities, to all kinds of people who own different kinds of certificates as well. So if I buy this Bored Ape for lots of money, but it gives me access to people like Stephen Curry, it gives me access to the guy from Elon Musk from Tesla. I can immediately communicate with him, and that's worth money. This is called ZRun. It's a virtual horse race. And you can buy a horse for about $250. You can immediately start competing with it. 70,000 people are watching these virtual horse races online in the platform Twitch. If your horse wins a race, it earns money and its status goes up. And the interesting thing is, if you have a male horse and a female horse, they can do a dirty thing. Then you have a young horse, and it can start earning money for you as well. My first horse that I bought was worth $250. It won 2 races, and then I sold it for $2,800. It's now worth $100,000, but I don't own it anymore. The NBA announced last week that they have this licensed, how do you say it? The licensed sponsorship with So Rare. So people can now buy avatars of famous NBA players. They can create their own fantasy game. They can start playing with each other and they can earn money again. And it all adds up to the metaverse. Because the metaverse needs a layer where you can own and buy internet stuff, digital assets. That's the big step we are now making. We are moving from Web 1.0 into Web 3, where we are solving the errors of Facebook, of YouTube, of LinkedIn, of Google, where we are entering a distributed network, completely different than we are used to. And the funny thing is, this metaverse is quite exciting. Because basically you go through the screen. If you put on an Oculus Quest, and I do it every week with my colleagues. Normally I have these meetings in Microsoft Teams a couple of times a week, and once in a week we enter this virtual space. I have the feeling that they are sitting in my kitchen, that they are virtually there, that I can almost touch them. So it's the embodiment of the internet. And it's not about pages, web pages anymore, but we are going to places, to new kind of realities. And if we are doing that, if we are going through the screen, we are becoming content ourselves.
Young flame here, sicko mode.
This is the rapper Travis Scott. He couldn't perform during Corona, so he didn't earn any money because he couldn't give concerts. So he gave a concert in Fortnite for 27 million people at once. The technology scaled his concerts up. This is my avatar with the red cross in front of it. I was totally flabbergasted when I watched it, and I still have goosebumps when I watch the concert back. I have digital memories about this event. And
the experiences, experience.
This is Mark Zuckerberg. He gave a speech that lasted 1.5 hours when he announced the movement from Facebook into Meta. And I recorded it, and I made a compilation of it. He said 250 times, he said experience. Experience is the most important thing in this virtual environments, in the metaverse. And it's not only for young people, it's also for old people. This is ABBA, the famous pop group of the 70s, the 80s. Last year they produced their latest CD, or their last CD. They are over 70 years old, so they are not going to perform anymore. But they want to be in contact with their fans. So they've created these holograms, these avatars of themselves. They call them avatars, and they are now performing in London. A couple of months ago, I went to this concert with my wife, and I can show you a small compilation. completely fake. But the moment that they are on stage, you start dancing, you start singing, because you have the impression, the feeling, the experience that it's real. And, well, ABBA, they are over 70 years old. They are going to die, of course, in the near future. But this will last infinitely. So we now have these questions about death in the metaverse. Can you die in the metaverse, yes or no? There's this young mother from South Korea. She has lost her daughter when she was 6 years old to an awful disease. In a couple of years, she used virtual reality. She hired an agency office that created her, or recreated her daughter. It cost her 150,000 euros. This was the example.
엄마 어디 있었어? 엄마 내 생각했어?
맨날 해.
아니 엄마 많이 보고 싶었어.
Well, kind of weird, kind of strange. Do we want this kind of technology? Did the girl want herself to be recreated in the metaverse, yes or no? But this was a couple of years ago for 150,000 euros. You can now do it yourself.
My God. Holy smokes. She's alive.
Yeah, it brings the picture to life.
Look at that smile. Oh, God.
Isn't it amazing that technology?
I can't believe it. Oh.
Oh.
It's her.
Yeah.
A positive use case, in my opinion, for synthetic media. And you can earn money with it.
Greetings. I am Salvador Felipe Jacinto Dalí y Domenech. And I am back. Before you leave, you will take a picture with me?
Sure. Yeah.
Alors. 1, 2, 3. Ooh la la!
So, well, if you can make a selfie with a dead celebrity, all kinds of ethical questions go away. I've talked about a few things. If you look at the future, look through the eyes of Generation Z and Generation Alpha. Internet culture is the most dominant culture worldwide. 2 laws: fake is the new real, and fake will be worth more than the real thing. And it all gives us the tools to start playing with reality. And does reality matter anymore?
How do we know what is real?
And what would reality mean when a world we can build feels as real as our own?
And the young girl was like, why? And I was like, what do you mean? She was like, who cares if it's real? And I was like, what, you don't care if it's real? And she was like, no.
Young people don't care if it's real. Digital is more important than physical. If you look at Apple, they are creating a reality processor, they call it. Reality glasses. Reality will be the new platform that we can start building on top of. Mark Zuckerberg even introduced it, a small movie where he talked with an AI. He told the AI, create me an island, create me a radio, play some songs, and it immediately started working. No code, just talking with an AI, and a virtual reality was created. And that's the interesting thing. If you think about marketing, it's all about, if you think about communication, if you think about how we people started to survive, it's all about storytelling. And now we have the tools to build all kinds of realities. That's the major job for all kinds of companies. How will your reality look like in the metaverse? Will it be scary? Will it be fun? Virtual humans for your company. How will they look like? Have you even thought about your company logo? How it looks like in 3D? One of the simplest questions. If we are entering the metaverse, it's 2D. In the metaverse, everything is 3D. So start building, start experimenting, and don't be afraid. Open a TikTok account. Start experiencing what TikTok does for you. Buy an Oculus Quest, put it on, enter a virtual reality, and experience what it can mean for you. Start building new kinds of realities. Well, 83 slides, lots of visual information, kind of information overload. If you have any questions, you can ask them now. And some people always have one question by seeing this slide. Why is there a cat in a shark costume on a vacuum cleaner? I have no idea. Thank you.
I know it's late and we're wrapping up the program, but anybody has a question for Sander?
How quickly do you think companies like Facebook can monetize on the metaverse? I'm a big VR player.
Okay, good question. I still have, as I told before, as I told during my speech, once a week I have these glasses on with my colleagues to have this meeting. After 1 hour, I'm totally tired, I have a headache, so the technology is not there yet. And if you, even Mark Zuckerberg tells it himself, this will happen after about 10 years. And this morning I got a question from other people in the room. They asked me, when should we start investing in these kind of new technologies? Wait a couple more years. Even Gartner, Forrester, the big agencies that do all kinds of consultancy, the hype cycle of Gartner, they predict that the metaverse will be grown up in the next 10 years. So we are still early, but start experimenting.
How do we find you on TikTok?
Type in my last name. That's it. Other questions?
Maria? Oh, no.
What about TikTok? TikTok, one of the problems that I see every user and how to talk about one of the things I'm really concerned, being not a US company, is, for example, I watch a lot, and one day I was discussing with my assistant the purchase of a van. And suddenly, I mean, the phone was far away.
Yeah.
And suddenly I get an ad on a van.
Mm-hmm. Yeah.
So security concerns. So I mean, this can be espionage because they are hearing exactly what we're saying and picking up on some words.
Yeah.
So how do you see the evolution of the control of companies like that?
I think the same happened 10 years ago with Google and Facebook. And then I didn't hear the United States people complain. And I was a European and already my data was over there. And now my data is in TikTok. So I think it's kind of the same problem. But because of Google, because of Facebook, we are now more aware of the problems that can arise. Even the 6th of January, the conspiracy theories, lots of those kind of things happened because people in the United States were in their own filter bubble on Facebook. They believe what's happening on Facebook instead of the normal news channels where there are journalists. So this will happen again, and it will happen with TikTok. I think it's well. I think in Europe is now all about regulations against companies like like Facebook, like Twitter, like Google. We are adding up on it, millions of dollars of fines. They are